The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit futuremoneytrends.com/gold. Greetings and thank you for joining us at futuremoneytrends.com. I'm here with a very special guest. He's one of the top gold analysts in the world. He's been writing on the Gold Antitrust Action Committee for years. That's an organization everybody on this show is familiar with, GATA. He also wrote for Miles Franklin. He's now partnered with Jim Sinclair at jsmindset.com. Bill Holter. Bill was also a Wall Street broker, including a manager for A.G. Edwards for 12 years. So he is kind of a former Wall Street guy. He's definitely a gold expert, and I'm happy to have him with us today. Bill, thanks so much for joining us.
My pleasure to be here, Daniel.
Bill, I wanted to get right into what's the big story on the news, because a lot of people don't fully understand this, because it's just not something a lot of people, everyday investors, buy, and that's the junk bonds and the bond market itself. You know, when we see bond market crisis, liquidity crisis, what exactly is the danger in what's going on right now with junk bonds?
Well, first off, junk bonds are lower rated, lower quality debt, lower quality bonds. And as such, you would expect if there's a problem that those would be the first ones to be the canary in the coal mine, so to speak. And that's actually happening. The liquidity is gone in the junk bond market. There have been 3 hedge funds now, I believe, that have gated their investors. In other words, they're no longer allowing redemption, so you can't get your money out. You're stuck. The liquidity has dried up, and a money manager who wants to sell a very small amount, say $1 million worth of bonds, might knock that bond price down 10 points or 10%. When the bonds get sold 10 points lower or whatever, they've got to be remarked across the broad spectrum of portfolios at that new price. So what you were carrying on your books at 100 or at 90 yesterday, now all of a sudden you got to mark them down to 80 or 90 today. So you've got to show a loss. And portfolio managers are petrified, because if any big orders come in, these bonds are getting decimated. And I might add that a lot of people, a lot of retail investors have been forced into the junk bond area. When you put your money into what they call a high yield fund, it sounds nice, high yield. But what it really means is lower credit junk paper. People did that because CD rates, interest rates across the board went down, and there was a search for yield. And that search for yield pushed retail investors into the riskiest category. And now that's beginning to bite.
Now, Miss Yellen says this is contained. It's almost like the echo of Bernanke in 05 or 06 saying subprime is contained. Is it contained?
And, in 07 he was saying that subprime was contained. That's a bunch of bull. This is the beginning of a credit unwinding, a credit meltdown, credit collapse, whatever you want to call it. This is the beginning. It's the tip of the iceberg. The liquidity across the corporate debt market has been shrinking. The liquidity in the municipal bond market is shrinking, and even in the treasury market, liquidity is shrinking. It's tough to offload any big trades without impacting the price. We don't have the liquidity that we had 3 years ago. So if you think about it, and I know you used to be in California, you saw the real estate market collapse. The first thing to go is volume. Mm-hmm. In other words, all of a sudden houses that were for sale would sit on the market, and there was not a lot of turnover. And then the prices collapsed. And that's what you're seeing in the credit markets. You're starting to see less and less volume, less and less liquidity. And you're now seeing that manifest itself in, particularly in the junk bond market, where prices are moving, they're down 10 to 20% in a short period of time.
Yeah, and most people look at bonds as being very safe. It's kind of that that conventional wisdom, retirement asset allocation. You go to stocks when you're young, and you move to bonds when you're old. I mean, how systemic is this to the overall markets? How big is the bond market versus the stock market?
Well, the bond market is multiples the size of the stock market, and that's worldwide. If you look at where interest rates are, let's look at the 10-year Treasury. How safe is a 10-year Treasury if you're locking it up at 2.25%? And we run into inflation and rates go to 5 or 6%, or real inflation and rates go to double digits. You're going to be wiped out in bonds. Your price of the bond is going to collapse, and your purchasing power of the currency that you're going to get back will have been greatly diminished. And that's talking about treasuries that theoretically have no default risk. What about municipal bonds? What about Puerto Rico? You're going to end up with a haircut, you're not going to get all your money back, and you're not going to be paid in a timely manner. And same thing with many corporate bonds. Look at the oil patch. You're looking at $500 billion or more in the oil patch, and probably 50% or more of that debt that's been taken on just in the last couple of years is now impaired because of low oil prices and low natural gas prices.
It's almost building on itself too, because now we have a really just severe, nasty deflation across the commodity sector. The fake, the bridges to nowhere, the ghost cities, the whole China thing is completely imploding. And, here you got oil on 35, probably on its way to 20. Do you think that this is kind of that moment, perhaps 2017, where we have the deflation and what causes the currency crisis and potentially a hyperinflation is the response that we're about to see, the helicopter money?
Right, it is the response. But you also have to look at it from the standpoint of, even if they don't print, which I'm sure they will, but even if they don't print and you have defaults left and right, the currencies themselves are debt-based. I kind of view this deflation as a snake eating its own tail. And the tail is now fully and completely in the snake's mouth, and he's beginning to gobble it down.
Well, it's also creates the potential for war. I know you do a lot of research. Your job is essentially research and digesting the news. Really reading the news and letting your subscribers, letting the people who visit JS Mindset know what's going on related to gold and silver. Is war something that looks like it might be on the horizon?
Well, war has always been a way for the bankers, if you will, to turn the economies and turn the markets. War has been a way. War got the world out of the Great Depression. World War II did. Just the ramping up of production for arms and munitions. So I view what's going on now. We're headed financially. The West is headed financially toward an outright collapse and public knowledge or viewership or whatever you want to call it, that the system is and has been for years a Ponzi scheme. And the West is poking Russia. They're poking the East, trying to provoke a war. And I've said this several times in the last week or two, that it looks like it's a race between which is going to happen first. Does a war get started, or does the truth come out of the Ponzi scheme and the West collapse? Because the West really, truly needs something to point at to be able to say, our policies would have worked if it wasn't for this war or whatever event.
That's a great point. No, they can always, rather than, they could probably even blame capitalism. Who knows what, I mean, just like 2008, I mean, that wasn't capitalism, but they certainly blamed it. And,
well, they have to be able to say it was not our fault.
Yeah. Yeah, no, and war would be the ultimate, of course, game changer, just like the
Exactly.
Great Depression. We're all brainwashed in high school that the war got us out of the Depression. Okay, sir, since we mentioned interest rates a little bit. We're doing this interview on Tuesday, tomorrow, the 16th of December. It is likely the Fed is going to raise rates. Now, we know that they've done a masterful job with price suppression and manipulation of the precious metals, specifically manipulating all markets, but specifically the precious metals in a very sinister way. But with that said, QE and low interest rates, everybody thought gold would go to the moon. It did the opposite. Now here we got rates that looks like they're going to go up, and people think that this is the death of gold. Could it be the opposite? Rates go up on tomorrow, and that marks the literal start of the new bull market for gold.
Well, go back to the mid to late 1970s. We had higher and higher interest rates from 1976 through 1982, and gold had its best move the 4 years between 1976 and 1980. The bubble didn't pop, it didn't burst until Paul Volcker started moving rates into double digits. Today is we live in a different world today. Back in, call it 1980, when Paul Volcker raised rates, he was able to do that. They're not able to do that today because there's no collateral left to borrow against. Everything has been borrowed against. We had a federal deficit that was able to be expanded. We were at, 20 or 30% of GDP for federal debt. Now we're at 100% plus of GDP, and if you add in all the promises, future obligations, et cetera, like Social Security, Medicare, loan guarantees, things like that, we've actually got over $200 trillion in debt. So there is no room to truly raise interest rates because they can't pay the interest rates. Whereas back in 1980, there was plenty of room because there was collateral to borrow against, and servicing the debt was doable. So you've got two things here. First, when interest rates really started to move from the 74 to 76 period on up, it took we had a 4-year bull market, 5-year bull market in gold, where gold went higher with interest rates going higher until it got to the point where interest rates were too much competition for gold, which didn't pay interest. I'm going to tell you, if interest rates go to from 0 to 1 or 2%, that's still not competition for gold.
Yeah, well, if interest rates do go up even a little bit, can the U.S., I mean, this is literally a zombie economy, a zombie monetary policy. Can it even realistically, I mean, people are thinking, it's going to be a quarter on tomorrow, and then within 3 years, it's going to be, at 3%. I mean, is this just all really...
Well, that's mathematically almost impossible because at 3% Fed funds rates, you'd be looking at, 5% on a 10-year treasury, something like that. Put 5% to 20 trillion. If our debt averaged an interest rate of 5%, you're looking at $1 trillion a year versus currently, I think it's 500 billion per year in debt service.
Yep.
It's not doable.
Yeah. Plus, I imagine you'd have a declining tax revenue. So, man, that would make it even look worse, right?
Right. You would. Let me add this. You need to understand that in order for them to raise rates a quarter of a point, they don't just magically flip a switch. What they have to do is they've got to take collateral, the repurchase agreements, they've got to take somewhere between $300 and $800 billion worth of collateral out of the system. Now you wonder, Is that levered only one time? Is it 2 or 3 times? I don't know. But you're looking at a system that's already starved for liquidity. You can see that by velocity. You can see that by the fact that there's no money in the streets. Can the system really go forward if as little as $300 billion of collateral gets taken out of the system? That's from a financial standpoint. I think immediately it'll do less to the real economy, but I think that will really upset the financial markets, and you could see some derivatives going boom left and right. And there are some derivatives that have already gone boom in the oil patch, the copper, zinc, the commodity patch. You could see this thing unwind really quickly.
Bill, moving to gold and silver, it's been a great disappointment for many investors. Some people bought gold for insurance, and it's serving its purpose. Many people bought silver because of the fundamental story where you've got this surging demand, tight supply, and now we're in a situation where zinc mines are closing down, copper mines are closing down, and that's a lot of silver that's coming off the market. But demand does not let up for silver. Where are we with the physical precious metals? I've heard, and seen all kinds of reports about a possible shortage for years. I've even come to that my conclusion that at some point there's got to be a silver shortage. You're looking at the markets every day. You're looking at the physical side and the demand and even the manipulation to an extent. Where are we with the precious metals right now?
Well, look at what China's done. They've already imported and delivered out through the Shanghai Exchange over 2,400 tons of gold. That's all the production in the world. If you take out Russia's production, you take out China's production, which they do not export, that is all the production from all the gold mines throughout the entire world. Demand is definitely outstripping supply, and the supply can only be coming from one place in order to satisfy deliveries, and that's got to be Western vaults. Now, if you look at what they've done from a price standpoint, they've continually pressed the price down, and they've done that with futures contracts. You can see that on the COMEX. For instance, this month alone, a couple weeks ago, there was 24 tons of gold standing for delivery of less than 4 tons that COMEX says that they have to deliver. Now, that's been whittled down. You've seen day after day that amount drop via cash settlement. But I'm going to ask you this: on the first day notice, all of that 2,400 or the 24 tons had to be fully paid for in accounts. Who in their right mind would fully pay for the delivery amount of gold and then walk away and say, no, I don't want it? The only reason they're walking away and saying, no, I don't want it, is because they're getting paid premiums in cash not to take delivery. Wow. Another point is, if you look at what's going on the LBMA, the London market, gold is in more severe backwardation now than it ever has been. And what that means is gold is priced higher today than it is in the next future month, 3 months out, 6 months out. And in a real world, a world with a true rule of law, that cannot happen. And the reason that can't happen is because if you have an ounce of gold today and you lend it to someone, it's going to be worth more in the future because you're going to earn interest on it. Mm-hmm. And the negative GOFO rates are illustrating that one of two things. It can only be one of these two things. Either that physical supply right now is not enough to meet the demand for current delivery, or traders, investors are fearful that they'd rather have the gold in their hand today because they don't believe they're going to get the delivery in a month or 3 months or 6 months. So that's the only two possible reasons with gold. And I say with gold because it could happen in, say, sugar or wheat or something like that, because you could have a bad harvest or something like that that would cause backwardation. It can't happen in gold.
Bill,
because it's fun.
Bill, with gold and silver, obviously very undervalued right now. I mean, it's almost like a beach ball underwater. Do you also look at the mining shares as an investment opportunity?
Yeah, the mining shares are stupid cheap. You've got gold and silver at or below the cost of production, and you have the mining shares trading like gold is, call it $200 or $300 an ounce.
That's incredible.
I mean, going forward, in my opinion, silver is going to be gold on steroids, and the mining shares are going to be silver on super steroids.
Do you think we've reached a bottom? I know that's a very tough question to answer just because there is sinister manipulation involved in the precious metals from governments, from central banks, from bullion banks. But do you think that this is about as low as we're going to see, or do you think we will see single-digit silver and $900 gold, which is everybody's concern right now?
Well, I think we're close, both price-wise and time-wise. Just the fact that there are shortages, backwardation, that tells you from a physical standpoint we're at an inflection point. Now, can they get gold to 900 or silver to a nine handle? Yeah, it's possible. They could do it with paper contracts, but go back to 2008 when silver, I think, traded down to $8.99. No real silver traded under $15. So they can get those prices, but there won't be any to be had at those, any real silver or real gold to be had at those prices. You'll just see the premiums go up and that the price will remain pretty much where it is right now.
Bill Holter of jsmindset.com. If somebody would like to reach out to you, where's the best place for them to go? Is it just jsmindset.com? Yeah,
you can go to jsmindset.com, or you can reach me at my email, bholter@hotmail.com.
Bill, thank you so much for your time. I really appreciate it. You explained this, the junk bonds, gold and silver, and raising interest rates very well. I look forward to sharing this with our subscribers. I think it was such a great explanation. We'll actually probably be doing a transcript as well. So I really appreciate you taking the time with us today.
Thanks, Daniel. My pleasure.